if you don't hold it, you don't own it. And particularly when we are looking at all of the debt that is about to explode, and some is already exploding. Let's talk about that, because the elites have raised the debt alarm. Wow. And I'm wondering, do you think that we can have a soft landing? Do you think that they can avert the crisis that they encourage? Especially when, if you look at everything on TV, the surprise inflation, surprise this, surprise that. Okay, I'm scared. You should be too. You've got to have a wealth shield. Here at ITM Trading, we have a wealth shield. And that shield is made of metal, physical gold and physical silver in your possession. This is critically important. It's not the only thing you need, but it's the foundation of what you need. Because with gold, you can maintain any of your fiat money assets that you have. You can protect against the collapse in the markets. And with the silver, you can maintain your day-to-day living. There are different types of gold and different types of silver, so it always has to start with your goals. But the first goal is, and should always be, protection. And there's your foundation. Then you also need food, water, energy, security. You've got the barter ability, the wealth preservation. That community piece is critical, and your shelter. That's what Beyond Gold and Silver deals with, but these are all the things that we need to maintain a reasonable standard of living. Get it done. Please get it done. I'm so grateful that I'm in this industry and know how deeply I dig into stuff. Believe my work. So many people could tell you what you should do when they're not doing it. I'm only telling you what I am doing for myself. You make the choice on whether or not that works for you. But I feel so strongly that you should always do what the smartest guys in the room do for themselves. And there are many things I don't know, but one thing I do know is currency regime shifts. That I 100% know. I've been studying it since 1987. Know anybody else that has?
The heads of the world's biggest international finance institutions sounded the alarm about record global debt levels, with the International Monetary Fund's chief saying options to deal with the billions owed by poor nations are disappearing. Both organizations have for months flagged risks from rising debt levels in emerging markets, particularly as interest rates start to increase to cool accelerating inflation. The World Bank estimates that the poorest countries, whose fragile economies have been decimated by the pandemic, owed $35 billion in payments in 2022. The urgency to avert what Georgieva has termed economic collapse for some countries is growing after the group of 20 biggest nations, reprieve on debt service payments for about 70 struggling nations, in place since May 2020, expired at the end of 2021. A plan forged by the G20 in late 2020 to rework the debt of countries in danger of defaulting, known as the Common Framework, has been hampered by a lack of coordination, transparency, and clarity.
Because those at the top raise that debt alarm as options vanish. And the reason why the options are vanishing is because the whole world is between a rock and a hard place. They've used interest rates and dropping interest rates for decades to encourage more and more and more debt. And now, I guess we've reached a point because they have to raise, central bankers have to raise rates, or at least, there was lots of experimentation going on, let me tell you. But at least in theory, they have to raise rates to combat the inflation. Will it work this time? We'll find out, but frankly, I don't think so. But they still have to raise rates for their credibility. The problem is really in the weakest link at the moment. Although honestly, whatever I'm going to show you here, so much of it is applicable globally. Because right now there are 13 emerging markets, EMs, emerging markets, that have bonds trading at least 1,000 basis points over treasuries. In other words, they have to get paid for the risk that they're taking. Nobody's been getting paid for the risk that they're taking. But these 13 emerging markets are in deep doo-doo, to put it bluntly. And here's the piece of it. The urgency to avert what Georgieva has termed economic collapse for some countries is growing after the group of 20 biggest nations reprieve on debt service payments for about 70 struggling nations. It went in place since May 2020, and it expired at the end of 2021. So you see, when everybody asks, well, will they just forgive the debt? Here's an opportunity. You think they're going to forgive that debt? I don't think so. But they did suspend the debt payments. Now these countries have to make these payments, and they can't do it. They're having a lot of trouble with it. Does this sound familiar? Because it's really happening on so many different levels. We're just talking about emerging markets, but we could be talking about student loans. We could be talking about any level of debt, frankly, real estate, etc.
In a world of paper profits, digital trading, and currency creation, physical silver stands in contrast as one of few assets that you can carry in your pocket anywhere you go, even in another country, and it can be as private and confidential as you want. Physical silver is also a tangible hedge against all forms of hacking and cybercrime. There's no erasing a silver eagle coin, for example, but that can certainly happen to a digital asset.
So what else is one of those repeatable patterns? Well, gold provides downside protection. This is not rocket science. This is global equities, UK gilts, and gold returns in British pounds during periods of systemic risk. Because gold is a proven safe harbor. And you can see how it's performed. Dot-com bubble, 9/11, Great Recession, sovereign debt crisis 1, sovereign debt crisis 2. Remember, sovereign's government. Brexit, 2018 pullback, and COVID-19. What do you want to be holding? Because this, on top of the end of the currency's life cycle, means that we're quickly approaching a point where the dollar will have zero, count it, zero value. Last, its most widely recognized feature is its potential value in highly adverse scenarios, and it's called the war chest argument. But it's been proven over and over and over again. So I'm good with it. And that's how I'm protecting myself and my family. That's also how I'm positioning to take advantage of the opportunities that present. And there will be many opportunities that present. Because right now, with all of the new money that's been flooding into the system died in 2008. I don't really care what anybody says. It died. And they just put it on life support, and that life support was massive money printing to reflate the targeted assets. Stocks, bonds, real estate, because of the massive amount of derivatives that sits on top of all of it. Minimum 610 trillion notional. Notional means nobody knows the true value at risk. I don't know it. You don't know it. They don't know it. They admit they don't know it.
For a relatively small asset class, gold gets a lot of attention. The reason is that gold has become established as a type of anti-money. It is viewed as the opposite of fiat currencies like the US dollar and euro. The primary reason for this is the fact that supply is limited, while the supply of fiat money is theoretically unlimited. Every year the amount of above-ground gold increases by just 1.5%. That number is likely to fall in the future as below-ground reserves are decreasing by as much as 5% a year. Around 60% of the demand for gold comes from the jewelry, electrical, and medical industries, and this demand is fairly stable. The other 40% of demand comes from investors and speculators. It is this demand that drives the price. This dynamic between supply and demand means that the value of gold is stable. What the price of gold really tells us is the value of the US dollar and other currencies. It is also regarded as a real asset, unlike bonds and currencies, which are financial assets. Investing in gold is a way to speculate or hedge against the value of financial assets.
And central banks turning more hawkish, in other words, raising rates, as they try to bring inflation to heel, which hasn't been working very well. Developing market borrowers have become more skittish. and they're going to the safety of gold because gold has been a proven safe haven for thousands of years. And I just pulled these. Both of these are from the IMF. Latin America hit by one inflationary shock on top of another. But is it just Latin America that's being bombarded with inflationary shocks? Because we've been pretty surprised by the numbers here in the U.S. too. And wow, in Turkey, wow, they've raised their forecast from 23% inflation to 43 or something like that inflation. So, and we had the World Economic Forum and the IMF. I mean, everybody's cutting growth and increasing inflation expectations, one shock after another. But here's the real key in this. We'll look at that and then we'll come back to the key. Price pressures. So this is Latin America. This is the current forecast. This is the previous forecast. So the blue is the previous, the red is the current, and you can see that the current forecast for inflation is spiking, right? Well, and guess what? They're probably going to be underbidding it, or it's probably going to be even higher than what they're forecasting. And here's really the problem for the governments and the central bankers.